Hi, welcome back to Joe Blogs. This video is the next in a series looking at the financial implications of Russia's invasion of Ukraine on the global economy. And in today's episode, I want to talk about interest rates. Now, interest rates are something that are very closely aligned to inflation. And as you'll know, inflation is at high levels in a lot of countries all around the world. And the traditional way of central banks and governments dealing with high inflation is to increase interest rates. And normally there's a perfect balance between the two. As interest rates go up, inflation should come down because the cost of borrowing goes up, therefore people have less money, they spend less, demand goes down, and therefore prices come back down. And that works well in a normal environment. But the problem that we've got right now is that we are not operating in a normal environment. Over the course of the last 2 years, the world has built up large amounts of debt. Because of the lockdowns that were brought in as a result of the COVID pandemic, a lot of countries introduced schemes whereby they were paying individuals and companies on furlough schemes, and that took country debt to unprecedented levels. But in many countries, it also increased the amount of corporate debt because companies had to keep alive, they had to keep paying their bills, paying their staff, and therefore they borrowed more. And in order to help ease the burden, central banks all across the world reduced interest rates to record low levels. Now, unfortunately, the reaction of that from a lot of the population was to borrow large amounts of money. A lot of people decided they wanted to move house, they wanted to move out of towns and cities into more rural areas. Working from home became more established as a practice, so therefore you could move further away from your place of work. You didn't have to go to work for 3 or 4 days a week, so it worked very nicely. And we saw property prices explode over the course of the pandemic. People borrowed as much as they could at very low rates, and everything was perfect. So as it sits today, in many parts of the world, we've got record amounts of debt on a personal, company, and national level. And now we are starting to see massive increases in interest rates. And that is going to cause problems for a lot of people and companies and countries because everybody has got used to very low interest rates, being able to afford those interest payments. But as interest rates start to double, quadruple, and more, it's going to put a massive amount of cash flow pressure onto everybody. So in today's video, I thought it would be interesting to look at the current rates of interest in the G20, the 20 largest economies in the world, to have a look at how they compare and what the absolute rates are. Because rates have already started to go up, but they are nowhere near capping out. We are going to see further increases, and these interest rates could be big and they could come on a regular basis. And whilst we go through the G20, I want to pay particular focus to what's going on in Russia, because I've been looking at these figures and I simply can't understand what the Russian central bank is doing. Shortly after Russia invaded Ukraine, the central bank increased interest rates from 9% to 20% as an emergency measure to make sure that inflation didn't go sky high. So I can understand that logic, and inflation did jump from around 9% to around 17% overnight. But over the course of the last 6 months, we've subsequently seen the central bank reducing interest rates back down from the 20% to 7.5%. So there has been a massive increase and then a massive decrease in interest rates. And over that period, we have seen inflation remaining very high in Russia. It has come down slightly from the March-April figures, but it's still in double digits, which would represent a red flag for every other country around the world. So it does seem very peculiar what's going on. So we'll touch on that in a bit more detail. We'll then have a look at what's going on with regards to inflation, because that's intrinsically linked to what's happening with interest rates. And then finally today, I'll wrap up with my summary as to what I think is likely to happen over the course of the next 3 to 6 months with regards to interest rates and what the implications are for these movements on the global economy. So before we get started on all of that, if I could ask you to give me a thumbs up at some point during this video, if you're enjoying the content, please subscribe if you haven't done so already. Don't forget, I always include chapters in these videos, so if you don't have time to watch the whole thing, you can pick and choose what you'd like to see. And if you'd like to support the channel, please have a look below where you'll find links to YouTube Super Thanks and membership, as well as Buy Me a Coffee, Patreon and Amazon shopping links. So as we've discussed many times before, there is a direct relationship between inflation and interest rates, and a lot of countries around the world are now aggressively increasing their interest rates to try to tackle high levels of inflation. So I thought it was worth having a look at what the absolute levels of interest rates are right now for the G20. Once again, I've ordered this list from the highest to the lowest rates. And as we just discussed, the rate of interest rate right now in Argentina is 75%. Now that is a mind-bending interest rate. If you want to take out a loan in Argentina right now, the base cost of borrowing is 75%. That's the annual amount of interest that you would need to pay. So if you took out a $100,000 loan, you would have to pay back $75,000 in interest every single year at the moment. So that's obviously an insane level of interest. Nobody would ever take out a loan at those levels. Even loan sharks only charge around 20%. So this is off the scale. And the reason that it's been put into place is obviously to discourage anybody from taking any debt on. And Argentina is trying to attract in overseas investment. Normally, if a government is offering high rates of interest, it will attract investment from other countries because they will see that as an attractive return. However, the risk profile for Argentina at the moment is far too high. So nobody really wants to put any money into Argentina. Currency is also devalued, so there are a lot of major problems going on right now. Interest rates in Brazil are currently 13.75%. Brazil has been increasing its rate aggressively to try to tackle inflation, and it has seen some results from that. Inflation has started to come down, but 13.75% is a high level. As I discussed earlier, Turkey's been following a completely contrarian view. They've been reducing interest rates over the last 12 months, but interest rates are still at 12%, so they're still the third highest level out of all of the countries in the G20. Mexico's been following a similar aggressive interest rate strategy to Brazil, and the current rate is now at 9.25%, which is up from 8.5% the previous month. Now, as I mentioned in a recent video, I'm not entirely sure what's going on with regards to interest rates and inflation right now in Russia. If you look at this chart, which shows the movement in interest rates over the last 12 months, you can see that following the invasion of Ukraine, rates were increased from 9.5% to 20% overnight, which is an incredibly aggressive thing to do, and the Russian authorities explained this as being a wartime adjustment. Even though they weren't at war, they were undertaking a special military operation. And then we saw that over the course of the next couple of months, the rate was reduced from 20% to 9% and is now at 7.5%. So over the course of the last 7 months, Russia has gone from 9.5% to 20% to 7.5%. And this is what's happened to inflation over that same period. So we saw an initial increase to around 17% in March. Inflation rose again to around 18% in April. And since April, we've seen a steady reduction back down to the current rate of 13.7%. 13.7% is the fourth highest level in the G20. And is certainly way above an acceptable rate of inflation. Most countries are targeting 2 or 3% as their long-term rates of inflation. So inflation isn't at the target level for Russia. So I don't understand why they've reduced their interest rates so much. You normally reduce interest rates if you want to stimulate inflation. You want to actually get prices to go back up again. So the message coming out of Russia is really confused. It's almost that they're saying we're happy with 13.7% inflation. That's where we want to be. And so we can now start easing off on the interest rate rises. But if you look at what's going on elsewhere in the world, we've got countries such as the USA that has 8.2% inflation that's aggressively increasing its interest rates to try to bring that back down. So you would have thought that Russia should have stuck with the 20% for much longer to get inflation down to 2 or 3%, and then it could start easing off. So it doesn't make any real sense what they've been doing. And that does lead me to believe that the figures that we're seeing coming out of Russia aren't 100% reliable because they just don't stack up. The words and pictures don't match. Going back to the list, the current rate of inflation in South Africa is 6.25%. In India, it's 5.9%. Indonesia, 4.25%. Singapore, 3.9%. Saudi Arabia, 3.75%. Now, China, the rate is currently at 3.65%. And if we look at what's happened over the course of the last 12 months, you can see that there have been some minor reductions. But the rate has been sitting at around about the same level for the last year or so. So it will be interesting to see what China does about the current inflation rates, because they're now at their highest level for more than 2 years, which would indicate that they need to start thinking about interest rate increases to try to bring that back down. But the problem that they have is that the economy is faltering right now in China. It needs to encourage growth. And when you increase interest rates, it usually will slow down growth because it increases the cost of everything. So there's a really interesting dynamic starting to emerge in China, and it will be fascinating to see how things pan out over the course of the next few months. Interest rates in Canada and the USA are now up to 3.25%, and that represents a rapid increase over the course of the last few months. But unfortunately, we're not going to stop here. The rates will be getting higher, and it's likely that we'll see interest rates hitting 4 or 5% over the course of the next 6 months in both countries. Official rate of interest rate in South Korea is currently 3%. 2.6% in Australia, but as I mentioned, inflation is on the up, so it's very likely that interest rates will also be on the up. The same applies for the United Kingdom. Current interest rate is 2.25%. It's very likely that that will be above 3% before the end of 2022 and is likely to hit a similar level to the USA and Canada of 4 or 5% within the course of the next 6 months. Now, the euro area stands out here as the outlier. The interest rate is currently 1.25%. However, when we looked at the inflation table, a lot of European countries are at the upper end of that table, and inflation in many of the countries is above 8%. So it's very likely that we will see the euro area following what's been going on in the UK, the USA and Canada, and the interest rates will need to rise aggressively and rapidly over the course of the next 6 months. And just to finish off, interest rates are currently 0.5% in Switzerland and 0.1% negative in Japan. So let's have a look at what's going on right now with regards to the current rates of inflation for the G20 countries, which are the 20 biggest economies in the world. This table shows the latest inflation rates, and I've ranked it from highest to lowest. So you can see that right at the top of the shop, not surprisingly, is Turkey, and the rate of inflation for September is now up to 83.45%, which is an increase on the figure that we saw for August, and is still at the highest level of any of the G20, albeit Argentina is making a big effort to try to catch up. The country with the next highest rate of inflation at 14.5% is the Netherlands, and the current rate represents a 2.5% increase since August. So that is a big jump in the month. Now, the problem that the Netherlands has is that it's part of the European Union, and it's one of the countries that signed up to the collective interest rate policy. So the Netherlands Central Bank is not in charge of setting interest rates in the country. That's being done by the European Union. And as you'll know if you follow the channel, the rates of increase in Europe have been far lower and slower than the rest of the world. And one of the reasons that the Netherlands is at the top of this list is that it's a big importer of oil. The Netherlands operates as a hub. It imports large quantities of oil and it also exports large quantities. So it's a trader in oil. And because the price of oil has risen dramatically over the course of the last 12 months and is also very volatile, it's feeding through into inflation in the Netherlands. Russia is number 4 on this list. The official rate of inflation is now quoted as 13.7%, which is actually a reduction compared with the rate that was published for August. However, as you'll know if you follow the channel, I'm not 100% convinced that the figures that we're getting out of Russia right now are very reliable. I think these figures don't really reflect what's actually going on with consumer prices in Russia. They've experienced a lot of problems with regards to the sanctions. They're unable to get a lot of products. There are shortages and there are massive price increases in a lot of product areas. So 13.7% actually looks like a relatively low level when you compare it to what's going on in other countries. Inflation in Germany is now running at 10%, which represents a major increase compared with 7.9% for August. The United Kingdom is no longer a member of the European Union. However, it actually had its own interest rate setting policy anyway, even when it was in the EU. And inflation in the UK is running at around 10% and remains a major problem for the economy. Inflation in Italy is now at 8.9%, which represents an increase on the figure for August. And once again, Italy is part of the collective interest rate policy in the EU, so is not independently in control of its economic decisions and therefore is unable to bring prices back right now. Inflation in Spain is also at 8.9%, however that does represent a reduction compared to the situation in August, and it'll be interesting to see whether or not that continues over the course of the next few months or whether this is a short-term dip and we see inflation rising again. Inflation in Mexico is now at 8.7%, which is the same level that we saw in August, but still remains high. And the situation is exactly the same in the USA. Inflation in September is 8.2% compared to 8.3% in August. So we're seeing a flatlining, but the level is still significantly higher than the target rate of 2% and remains a major problem in the USA. And so it's very likely that we will see continued interest rate increases over the course of the next 3 to 6 months. It's likely that interest rates will get higher and higher, and that's going to put a lot of pressure on people who've taken on debt over the course of the last 18 months. Inflation in South Africa is now at 7.6%, Singapore it's at 7.5%, and India we're at 7.4%. Now, the situation for all three of those countries has stabilised over the course of the last month or so, but the bottom line here is that 7.5% inflation is still incredibly high and is much higher than central banks are targeting for all of these countries. So everybody is still being impacted by what's going on in Ukraine. The higher prices we're seeing in terms of oil and commodities and food are still feeding through into all of these economies. And the bottom line is that everybody is going to be increasing interest rates, and it's going to reduce growth. Inflation in Brazil and Canada is now down to around 7%, which does represent a reduction month on month. So there is some progress, but again, it's still too high. Now, Australia doesn't release inflation on a monthly basis. So the last figure we have here is for the quarter ended June. You can see that the last figure was 6.1%, which represented a significant increase on the 5.1% reported previously. Inflation is currently around 6% in Indonesia, which is a big increase on 4.7% for the previous period. France has got its inflation down to 5.6% versus 5.9%. So it's actually doing okay, even though it's in the collective interest rate policy. Switzerland's at 3.3%, Saudi Arabia 3.1%, Japan 3%, and China is the bottom of the G20 list with only 2.8%. The trend in China is increasing. It's increased over the last 6 months. But when you look at the detail, the problem that China has is that food inflation is starting to get out of control. So what's the summary and conclusion today? Well, I wanted to post this video because we've been focusing a lot on inflation. Everybody's been talking about rising prices. How do we bring prices back down? And of course, the usual response to that is to increase interest rates. Job done. But you have to think through what is the implication of increasing interest rates. And the obvious answer to that is that it will make debt more expensive. So anybody who's sitting with large amounts of debt should be worried when they see interest rates moving. And unfortunately, right now, everybody has got large amounts of debt. And I'm talking generically. So the population of a lot of countries are sitting with the most debt that they've ever had. Companies have got very high leverage. And a lot of countries have got a record amount of state borrowing. So as interest rates go up, pressure is going to increase for all of those entities that have leverage. And that means that they will have less disposable income, less money to spend. So that will cause the economies of all of those nations to slow down and reduce. And as I've mentioned a million times before on the channel, the whole world is interconnected. So if we see a contraction in GDP in one country, it will have a knock-on impact to every other country in the world. But if we're seeing simultaneous increases in interest rates and reductions in cash, then that means that we will see a simultaneous shrinking of many economies, and the global economy will start to shrink rapidly. So what are the implications of this over the next 3 to 6 to 9 months? Well, let's talk about a couple of different markets, and we'll start with the property market. Property is intrinsically linked to the cost of debt. And what we've seen over the last couple of years since the COVID pandemics is as the cost of borrowing came down, the property markets went wild. And we've seen an unprecedented increase in the demand for property and the price of properties. And for the last couple of years, it's been a heyday. Everybody has been making a fortune. But unfortunately, the merry-go-round is about to stop. The price of borrowing is now increasing rapidly in most countries around the world, and all of the people who've maxed out on the amount that they could borrow are now getting very nervous. If you have a fixed-rate 30-year mortgage, then you're okay. But for all of those people who don't have a fixed rate mortgage or only have a limited amount of time for their fixed rate, they are now all starting to worry that as soon as their rate comes to an end, their payments are going to double or treble or quadruple or even worse than that, because we are seeing really big big movements in interest rates. A year ago, it was very easy to pick up a fixed rate mortgage in many countries around the world for 1 or 2 or 3%. Today, you'd be looking at 5 or 6 or 7% for that same mortgage. And that just isn't affordable for most people. They haven't budgeted for a rapid increase in rates in a short space of time. So that's obviously bad news for the people sitting with the debt. But in terms of the market itself, all of the new entrants, people who are looking to make a first-time purchase, are now looking at calculations, and it is a lot more expensive to borrow the same amount of money than it was 12 months ago. So that means that they can't afford to borrow as much, therefore they can't afford to pay as much for those properties. So demand is starting to reduce, and the amount that people are prepared to pay is coming down. And those factors mean that we are likely to see a reduction in the property market in most countries in the world over the course of the next 6, 12, 18 months and beyond. And unfortunately, because inflation isn't coming down anytime soon, it's likely that we're going to see interest rates increasing regularly over the course of the next 3, 6, 12, possibly 18 months, possibly a lot longer. And we're going to get to a new base level that is likely to stay around for a long period of time. So the days of base cost of borrowing being 0.1% are gone forever. It's more likely to be 3, 4, 5, 6% going forward. So that is going to be a sea change for the property market. And it's likely that we will see those markets starting to come back down over the course of the next 6 months. Now, in terms of the stock markets, there are two dynamics here. Firstly, there's usually an inverse relationship between interest rates and the markets. When interest rates are going up, it becomes more attractive to put money into bonds because they're paying a higher fixed rate, and markets tend to soften under those circumstances. But in addition to that, we've also got all of the companies that are listed on the markets who have debt. And all of those companies are now having to pay more for that debt because the base cost of borrowing is going up. So that will potentially then reduce their profits, which means that on a price multiple basis, if you're valuing those companies, if they've got less profit, then by definition, their valuation could well go down at the same time. So when you combine those two factors, you can see why the markets have softened over the last few months. And the outlook for interest rates is that they're going to continue rising, and they're going to rise rapidly. So that is usually an indication that the markets won't be performing well. They usually go into the red and may well come off significantly over the course of this interest rate increase. So that means that over the next 3, 6, 9, 12 months, it's likely that the stock markets will be volatile, they may well soften, and we could see the indices falling. And then finally, in terms of debt, we've got personal debt. All of the loans that individuals have taken out. And the problem that we've got right now is that we're looking at a combination of increasing cost on those loans as the prices go up and a potential reduction in GDP in a lot of countries. So that may well mean that wages start to come under pressure, people may lose their jobs, and we could see a high level of personal bankruptcies starting to appear in a number of different countries because people just can't afford to keep making those payments. So it's likely that as the globe goes into a slowdown and possible recession, that we could see a lot of individuals struggling, and this again may well be tied into the property market. If you've borrowed a lot of money to buy a property, the price of those loans is going up, maybe you can't afford that, maybe you'll have to sell on a forced basis, and again that helps bring down the price of properties if there are a lot of forced sellers. So the reason that I wanted to post this video is that the increase in interest rates that we're seeing all across the world right now is going to really hurt everybody that has debt, right through from private individuals all the way through to really big countries. And as I mentioned before, the longer that the Ukraine war goes on, the more we're going to have volatility, the more likely it is that we'll have inflationary pressure, and the higher the likelihood that interest rates will keep rising. And all of those factors are bad news for the global economy. So hopefully this has given you a good understanding as to why interest rates are so important and why they will be critical on the success of the global economy over the course of the next 12 to 18 months. So thank you for watching this video all the way through to the end, and don't forget to subscribe if you haven't done so already.